Welcome back. You're watching The Money Show on ET Now. Well, companies have been making a beeline to tap into the Dalal Street and go public. In the last couple of months, we have seen a number of companies really tap into the public's money by launching an IPO. Subscription numbers as well have been fantastic, and many of them have given superb listing day gains. In fact, more often than not, we have seen a lot of retail investors complain about how they've not got their allotment in the IPO that they have subscribed for. But is every IPO a good fit? How do you gauge an IPO, a company, especially when most of its information has not been made public yet? Let's understand that and more with Subhrajit Roy, Executive Director and Head of ECM Origination with Kotak Mahindra Capital Company. Subhrajit, many thanks for joining us today on the Money Show and ET Now on this, I hope, what will be an educative session for all of our viewers. So, Subhrajit, I think these last few months, IPOs, firstly, while companies may have made a beeline, even investors have made a beeline to subscribe for the IPO. I think all of the IPOs, literally all of them that have been launched in these last 5-6 odd months have been oversubscribed, and how. And they've been good in giving a listing day pop, a great return on the first day of listing itself. So let's start with first, Subhrajit, what do you think is leading to this, to this massive oversubscription, almost all of them gaining as well very smartly? I think it's very tempting for everybody then to go for every IPO that launches.
Sure. So I think a couple of factors, in a way, most of the IPOs which we have seen giving the kind of listing premiums that we have seen in this market, a lot of them are coming from sectors who clearly have either recovered very strongly from post-COVID or have been able to withstand the impact of COVID very, very clearly, right? So there are stocks which are, let's say, in the consumer spectrum or in the specialty chemical spectrum, or basically companies where pretty cash-rich, high cash flow companies, or strong brands like Indigo paints that got launched recently, or Burger King, which though was very impacted on due to COVID, kind of came back very sharply once the lockdown started easing, right? So wherever we have seen strong brands, sectors with strong tailwinds emerging, most of those companies have given good returns. And in a way, I think we have seen a combination of good companies coming to market, as well as a tremendous amount of liquidity flowing into Indian markets, which has naturally helped in those companies also getting good investor traction, as well as a very strong aftermarket.
Okay. All right. Now, of course, Subhrajit, the question, can we expect this for all future IPOs? Because I think, and we have got this question quite a bit of times on the Money Show as well, that with every IPO doing so well, should I put my money in the IPO market, especially at least for that listing day pop? So, Subhrajit, is this the right way to put it, and for retail investors to think?
So, we have a strong view, which is probably a bit contrarian, where our recommendation to the retail audience would be not to look at the pop, because the pop that we keep seeing, a lot of it is fundamental, but a lot of it is also driven by the technical factors, prevailing at the time of the listing. And there are many subjective matters which may be just relevant on the particular day. It's very difficult to read into going into the IPO. So our suggestion is that investors typically have made money on equities once they have held the stock at least for, if not years, at least for months. And that is where typically, if you see most well-received IPOs, if you actually wait out and look to sell over a couple of years, you typically make much more than what you would if you are just selling on the listing day pop. Of course, the listing day pop looks very attractive for wherever stock pops up 50, 70, 100%. But I think it is important to differentiate, companies where the listing day pop is probably happening because of market sentiments versus where there's a strong fundamental business model which you back. We believe the companies in the second category are the ones which are less exposed to market vagaries. And not too long back, we have also seen IPOs, back-to-back IPOs, which have not delivered to market expectations as well, right? I mean, we just happen to be in a good time frame, but the fact remains is we have evidence on the other side as well. So it is better. The retail investors will be better served if they look at the fundamentals of the company and look to at least invest in companies where they can make returns over at least 6 months to a year. And on top of that, if they get a listing prop, great. But we would advise against investing only for the listing prop, but more driven by whatever fundamentals that the company demonstrates based on the offer documents and few other signaling aspects that one can look at.
All right. So Subhrajit's view is that don't look at it more from the point of view of that return that the stock gives on the first day when it debuts on the large street, but rather look at it from 6 months, 1 year. And when we have to look at it like that, you look at the fundamentals. Now, Subhrajit, here's the tricky part. When a company announces that it's going to go ahead, it wants to launch its IPO, it releases a very fat booklet called the DRHP, or the Red Herring Prospectus. Now, you, of course, are astute at being able to skim through the prospectus, in a short period of time and being able to absorb the right quantity of information as well. There's a TMI syndrome that a lot of retail investors go through when they see the prospectus. So, how can one essentially be able to understand, what the company does, its past, present, future, with the help of the prospectus? Guide our viewers through that.
Sure. So you're right. It is a vast document across most IPOs, and anybody can get lost navigating through the prospectus and trying to do a full end-to-end read of it. But what I would advise is, even in the prospectus, 2 segments to really focus on. One is the business section. If it is a new sector coming to market, it is always interesting to go to the industry section, because it does give a lot of insights into how the industry is poised to grow, because end of the day, you have to be in a promising industry to really make returns as a company. But if it is a known industry and there are enough other precedents that are listed in the industry, then the important piece is to look at the business section. In the business section, the first few pages itself should give the investors a good summary of what the business entails. Secondly, if you look at the other important sections are risk factors. Again, risk factors would go into multiple pages, so a quick glance through is fine. Typically, they are more legal in nature, so just look at the headline items and see if you see something which is not typical to other IPOs, not just standard safe harbor statements. So I think those 2 within the entire prospectus would be probably the most relevant piece to read from a document perspective. But I think what is more efficient is you have a lot of intermediaries who publish analysts who publish reports nearer to the IPO launch. In fact, a day or 2 prior to the IPO launch, where they, in a quick summary, present what the company is all about, how's the industry, how is the company financials been, how has been the growth, if there are any major gating items, are there similar companies to look at from a valuation standpoint, and also sometimes a brief view of how they think about the company from a subscription standpoint. I believe in the interest, in the interest of keeping it efficient for readers who may not have the time to really flip through many pages in the document, though we would always advise readers to go through the document, but again, it is a function of time. You would find many of these reports that are getting published a day or 2 prior, whether it be in the online, on the online platforms, or it be in the offline, in the various newspapers, are quite handy summary of how we should look at the company. The other important, very important aspect, just from outside in perspective, is the anchor book, which gets public a day prior to issue open. That to my mind is the single most objective data point to look at from a company standpoint. Because if you have a very well distributed anchor wherein you see a pretty busy anchor distribution for IPOs and a good mix of foreign and domestic investors, right? You have the larger mutual funds, insurance companies on domestics. You have the large FIIs like Capitals or Fidelities of the world who are Nomura, who are anchoring a transaction. You kind of know that the pricing of the IPO has been validated by these anchor investors who have taken firm allotment. And one can reasonably be, form a view that these anchor investors, because they were locked in for a month, have taken a long-term view of the company, and they would not only come in the balance IPO, but also in the aftermarket. And normally, subject to markets remaining constant, normally IPOs with good anchor books have typically given decent returns. I mean, whether it is 10, 20, 50, 70, of course, is a function of the technical aspects prevailing at the time of listing. But broadly, people have made positive returns when the anchor allocation and the anchor investors who have subscribed to the IPO have been of a pretty high pedigree. So I think those would be the 3-4 aspects. Of course, document being the most ideal and the most extensive one, and I look at the anchor investor list as the most efficient and probably time-saving one. And between this and the analyst reports, I think can give an investor a reasonable idea on what the company is all about. Another quick aspect is, there are the company typically comes on media a day or two prior, when the price band gets announced, and talks about what they believe are the key selling points of the company. And they're often pretty short news bites of probably 5-10 minutes. I think those are also useful primers into how to think about companies. But the last but not the least, I think is worth highlighting is everything remaining constant again. If you look at sectors which have generally done well, companies which are strong consumer brands, companies which do not have high amount of where it is a very balanced balance sheet, as we say, in the sense that the leverage position, the capital structure is pretty comfortable, wherein let's say that debt to equity, these are slightly more technical terms, but basically the company is not over leveraged in terms of debt, and its company is generating a pretty comfortable level of PAT, or if nothing else, it's a very strong brand that we have seen in the market and are very familiar with. This kind of characteristics typically also lead to reasonably a good outcome. But then this is a multiple set of factors coming to play, and not really one particular aspect. I don't know if I've really answered your question, or have I made it more complicated?
No, absolutely. In fact, I think you eased it off quite a bit. A DRHP can be complicated. One simple way to do that, like Subhrajit mentioned, is the reports that you get. They're published in newspapers as well. They sort of do the heavy lifting for you, analyze the company, and then print the details on it in a crisp manner. So that saves a lot of time. A good tip given by Subhrajit is also looking at the anchor book. The mix of investors that have invested in the company, a good mix of foreign and domestic investors. The breadth and the distribution of anchor investors is as well a great and a very simple to understand cue. Sectors is the other important gist. Debt, equity, profit after tax levels, etc., are some of the other things which we anyway look at for listed companies as well. Subhrajit would have loved to take the conversation forward, but I'm afraid we're a bit short on time, so we'll let you go. Thank you so much for joining us on a session which, like I said, I hope has been educative for our viewers, and brace themselves for all the upcoming IPOs. Railtel is one such IPO, so keep in mind all that Subhrajit told you when you consider investing in this one. And for now, we'll take a very short break, but be right back with more.